Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, June 23rd, 2023. Right now it's 11:35 a.m. Eastern Time. I'm starting this video, and we're going to look at, as usual, start out with the broad markets. We'll look at some of the stuff I've been updating recently. It won't be a long one, 10 minutes or less on the broad markets. Just start out with the short-term charts, but then we're going to jump all the way over, which I like to do sometimes, to the longest-term charts. I usually go out to a monthly time frame. There are longer term time frames, but we'll go out to the monthly. We'll look at decades. We'll look at the great secular bull market that we're in, and the bear markets that we've seen or we're in within there, the cyclical bear markets. I'll show you that in 1 second. All right, let's just start out here on the 60-minute. We've been updating and recap. Bearish rising wedge, divergent high, breakdown, sell signal. And we've been zigzagging lower. As I mentioned yesterday, we still have all the signs of a near-term downtrend within a longer-term, intermediate-term uptrend. And again, we'll see if this is a bear market rally or if the market's headed off to new highs. As long as we don't take out the new highs, if we go on then take out the recent lows, the October lows, and that certainly will tell us that we're in a larger bear market, which I think we are, and this is a bear market rally. And I'm going to give you a couple other charts to that, because again, I get I read the comments, I read the headlines, and what some mainstream media is talking about, and I know there's a lot that are just can't wrap their heads around the fact that this could be a bear market rally due to the magnitude of it. All right, so that's that. Now we need to, as I said yesterday, we need to do two things to keep this near-term downtrend in play and potential. It has the potential, like any counter-trend rally, it has the potential to morph into a longer-term downtrend or we'll see. Now, so we want to ideally keep below this previous reaction high right there. And also, we're closer to this. We have a greater chance right now, just because of proximity, to take out that previous reaction low right there. And then that keeps that intact. So I haven't seen anything that changes my outlook. So really no update since yesterday. Still targeting at minimum, with all the zigs and the zags aside, work our way down to this intermediate term uptrend line off the March lows, the early March lows. So that's what I'm looking at. And again, if and when that happens, it'll probably be next week. By my, to keep that bear case alive, the bear market rally case really strong and intact, with pretty good degree of confidence, we really need to get down there and close the month of June down here or lower. The lower the better, and I'll get to that in just 1 second as to why, which again I've covered before. It's sort of an update, a recap. 15-minute chart, same thing, zoomed in a little closer. There's a downtrend line. There was that bounce. We were at that 360.43, a hair above the support on Wednesday, and so we had a bounce target zone. And like I said, by all metrics, we did take out the downtrend line because the downtrend line came in a little bit lower once we double tested that 360.50-ish support, and we had the divergence. We get the little rally up to it, and it was, and I still maintain an objective shorting up, as was a push into 366.21, which did the trick. That was these were the next two resistance levels, and really that bounce target zone from Tuesday, which was the trend line, and then those resistance levels above, and that's it. So, and still, at this point, we still, again, want to, I'd like to see ideally any bounces remain below that 367.50-ish, which is that previous reaction high, as well as that 61.8 fib. Hard to see, but right here. So far, this one stopped right at that 50%. And so by that, at least by that one metric, using Fibonacci retracements, just a typical run-of-the-mill counter-trend bounce. That's all it was. Nothing more, nothing less. Like I said, it didn't really change anything technically significant, at least not out here on the 60-minute daily charts or anything else. So we'll see. We'll see where we go from here, but nothing's changed on my views. Now let's look at SPY real quick, 60-minute chart, no change there. There was our divergent high. There was our breakdown, sell signal breakdown, hit the first support level. You have a gap right there giving you a support zone, back tested, bounced, back tested the wedge. And so far it's TA 101, breakdown, back test, working our way lower. We've now, only thing to update today is we're below. There's the gap. The gap was backfilled, as I mentioned the other day. That's where the buyers stepped in and bounced it. They bought the gap backfill, which is very common. It's more common than not, especially on a drop of that magnitude in an uptrend, to not see at least some dip buyers step in. So, ideally, again, this is just ideally at this point, want to remain below that that gap, which was support. Support once broken becomes resistance. If you do that, you have a reaction high here. That was really where we closed yesterday, and that's also now resistance. So again, it's not, these aren't all or none levels. It's not, completely binary. Well, okay, bullish if you take the gap back out. It's incremental. You take that out, and then if you take out now, you can see some mild resistance right there, 40, 36, 50, including the gap from today. So, there would be a gap backfill and then a rejection. That would be fine, but anything much more than that, again, it doesn't wipe this thing out. You're still well below the break point there. Maybe want to back test. But again, you got to decide where you want to, if you are short, where you want to stop out. There's the breakdown in SPY. Remember, we're in on QQQ first. This was just a confirming sell signal. All right, now let's do this. Let's jump all the way out, unless you want to see, which I probably should show you, the futures. That's the NQ 60-minute chart. Really no update. I covered this yesterday. The only thing in the last week or two that I've changed, I'm still targeting the same uptrend line that's comparable to the one on QQQ. Still my target. These are still the support levels that were there before, and this one I added yesterday as I covered. So, we hit this a couple times right here. We hit the 14,982-ish level. We bounced, had a reaction. They sold it. We're back down there now. So what we need to see, the next sell signal would come on a break below that level. So pretty much today or yesterday, this week's lows have taken out, whether that happens today being Friday or next week. That should open the door. There's your next support, 14,878 roughly, and then 1,400 in the trend line coming together. So, if things go as planned, then that should be where we're at next week. Maybe a gap down on Monday, who knows, or a move down there. And then again, I'll share my thoughts as to, whether I think we're going to head on down here. This would be a longer term swing and a very likely target, I believe, if that trend line is broken. That's 13,524 on the Nasdaq futures. From where we're at right now would mean another 10+% downside, almost 10.5 from where we're at right now. And whether you're trading it or not, always a good idea to keep an eye on the S&P 500. This is a 60-minute chart of the S&P 500 futures. I have alternative down. I have two trend lines, that one, and then this alternative. Actually, I drew that wrong. This one that comes off the lows right here in May, mid to late May. That one comes in there. There was the other one. Either way, they're both clearly taken out. They're comparable to those uptrend lines on SPY. This is support right here. We've had now 1, 2, 3 reactions. We need to take that out. And then your next support levels are here, here, here. But ultimately, I think we could work our way down. Again, if NQ, it's all about the Nasdaq. Obviously, the S&P is important. You want to see that follow. But this would be a deeper swing target for those looking something that should be. Let me just measure it out and see where that's at. That'd be about a 6.3% drop. Sounds about right. There's a lot of hot air in the Nasdaq, a lot more hot air than in any other, especially the regular Nasdaq, not the equal weighted. So it's all about those big fangs, and they are like, I'll use that analogy here in a second on the NASDAQ composite, which you're about to look. It's just like that submersible everybody's been talking about and following lately that imploded. You have a tremendous pressure, just like they go down, down, down. You read about it. Every 30 feet down you go in the ocean is about 1 atmosphere of pressure, meaning 30 feet down is twice the pressure than at sea level. And then you go down, I think that the Titanic rests about 280 atmospheres down, which is just, it's almost mind-boggling, that amount of pressure. So it's like, you have that when stocks become extremely overbought. We saw it here. That's here's my segue into the Nasdaq Composite. So that's looking at the Nasdaq Composite is somewhat, it's not exactly the same, but it's similar to looking at the comparing the Nasdaq 100 to the Nasdaq equal weighted ETF. So the Nasdaq 100, just your largest 100 components of the Nasdaq. Nasdaq Composite has it all. It's kind of not a perfect analogy, but a lot like I always talk about how the Wilshire 5000 is I consider probably the most representative index of the stock market, because you have small, mid, large, all different market caps, a lot of sectors, a lot of stocks in there. You have in the Nasdaq Composite, a whole universe of all the stocks that trade on the Nasdaq. So better measure to look at. And again, when you get very overbought, and we're on a monthly chart here, so let's just not talk about overbought on monthly. We're definitely overbought on the daily time frames right now, and that's what I'm referring to. But if you recall back here, so this is we were looking back as far as we can go on this composite back into the about 1990 right there. And we've had, in my opinion, again, I might differ from the mainstream media who still uses that antiquated definition of a 20% rise or fall in an index being a bull or bear market. To me, it's pretty simple. It's not rocket science. You can look at this and say, okay, what has the stock market, as viewed here by the Nasdaq Composite, been in for the last, 3+ decades now? It's obviously been in a bull market. You can go back farther in the S&P 500, and you can see it there as well, because the S&P has a longer track record. So you can see really back here, we were kind of in a flattish with a lot of bear markets moving sideways for here in the 70s. And then this, you can see we kind of broke out, and this defines this new super secular, we'll go down in history as one of the strongest bull markets in history. And why is that? Was it random that just at that point, about 1981 right here, early 80s, that all of a sudden we started launching, and it led to that first, big blow off top, the first real bear market when the 2000 to 2002, when the dot-com bubble popped, or the financial crisis, or what I believe it to be the next one? No, it's not mere coincidence. You simply look at interest rates. You go to the 30-year bond. I'll do the 10-year. We can do the 30-year. It looks the same. And something I've covered many, many times before. You had at that point a peak in interest rates. You had a secular bull market in rates, which is a bear market in bonds, meaning rates were going up. That was the last time we had hyperinflation, high inflation back in the late 60s, early 70s, big bear market back then. And then that was it. Rates peaked. We had 15+% interest rates at that time on treasury bonds, mortgages, CDs, things like that. And then we embarked on a secular bear market in interest rates, which by my account, I've covered many times, I believe is now over. And we've seen that, and that's it. It's a long one. That's long in the tooth. You're talking, going back to the beginning of the 80s there. And so again, it's not mere coincidence that coincide with the strongest and longest bull market in equities in history, because it's simple economics. That falling interest rates are bullish for the stock market for two reasons. They lower the cost of capital, which spurs economic growth, and it's the alternative to investing. When you can get a safe, I guarantee you right now, just about everybody listening to my voice would jump all over a 15% guaranteed government bond or CD at the bank and not have to worry about risk in the stock market to try to eke out what might be, an average return of 10% over the next decade or so if you hold that long, or could also be exposed to another 50+% bear market. So that's common sense. And again, this isn't binary either. This is all relative. Lower rates go, the more attractive dividend-paying stocks and riskier investments and junk bonds become. And then on the contrary, the higher it goes, more money will gradually siphon out of the stock market into those safe, high-paying bonds and safe fixed income investments, and it further stifles economic growth. So again, those are immutable facts or instances, if you will, or conditions, I should say, in the financial markets. Not just some theory that I have or anybody else. It's just proven over time, and It's how things work. So now the $1 million question is, okay, will this just be a blip and we're going to go back down to zero rate policy? And if we do, first of all, we'd have to do quite a bit to chip away at the technicals that show that we've probably bottomed here. That was probably a secular end to a bear market trend. We could certainly backtest the trend line. This is a chart, again, I'm spanning decades, so I'm not giving you micro analysis here. I'm not telling you where rates are going today, tomorrow, or next week. I'm telling you where they're probably going and where they've already gone to at that point. And if you look at it from this simple perspective, here's one more twist. And I know I'm extending my coverage of the markets here. So let's just play this game. Let's just look at where interest rates are today. And let's go back to where they were at previous points in time to kind of get a feel if there is that, and again, there's other variables involved, but let's just go off this. So interest rates right now are where they were back at the peak right here in 2007, before the end of the last bear market, also back in 2012. When that ended, and then all the way back here in 02, 03, 04, and then you flip that upside down and you look at where the stock market was back then, 02, 03, 04. Well, stock market was back here. There's 07, 08, 09, so 07 top. And again, over time stocks are going to go up. So certainly possible we get there. I have a bear market target of this primary uptrend line right here. And to be honest with you, I think longer term, if we're talking 5 to 10 years out, we'll take that out. I do believe I know all things come to an end. All trends, as big as they are, secular bull and bear trends come to an end. And so most listening to my voice, Randy, you're smoking some crazy. You think the S&P is going to drop? And I've been saying this for a while. You're going to drop from where we're at today, or let's just play the game off the highs because we're not too far from that. By the time we get there, it'll be about a 50% drop. If that happens, all I'm calling for there is a bear market in line with the previous two, which were about 51 and 58%, right? Nothing more actually on the lower end of that. And all that would be, to me, is kind of bullish overall long term if we do that and then rally on and go on to new highs. But again, I think this one's getting long in the tooth. Ultimately, I think we'll get a reaction off that level when we get there, the uptrend line and that 216 target. But ultimately, this, like all trends, will end, and then we're probably going a lot lower. But that's so long term that you can't position for it now, act on it. It might influence. If you happen to strongly believe that, you might not want to go start a business in certain sectors right now. You might want to kind of factor that in. What's that going to mean to the economy? What kind of businesses or things to do? How would I profit? What I do if that happens? What happens if we see rising rates? Well, rising rates, if you believe that, you want to start going into fixed income. You start building a bond ladder. You want to skew towards shorter maturities in that bond ladder because you don't want to lock in 30-year rates. So there's a lot you can do with long-term stuff, at least. But I just want to show you where we're at now. So now back to the Nasdaq. All right, so we're going to talk about that. And so say what you want, but that's my view, is again a simple view that you can really, it's not debatable. We've had two real bear markets and we are, I think it's safe to say, long overdue. And I also believe some will consider this a bear market. So far to me, it looks more like a correction in an ongoing trend. One of the things to support that are my bull market uptrend lines. So we've had three distinct and powerful bull markets really since that era of low rates. Remember, we were kind of just consolidating there and we broke out early 90s. So this was the first one up until that point, one of the strongest in history, from the early 90s all the way to that final blow off top, and referred to as the dot-com bubble. And then we went on to ultimately, after that bubble popped, we had a little parabolic blow off top there, but we went on to break the nice, clean bull market uptrend line. Then we had a bear market, right? And that bear market ended, and then a new bull market started. And it might not look like much compared to these two. These two were mega bulls, but that one was the one that ended in the 2007 highs, financial crisis. I already gave you the numbers there on what the Nasdaq did. And then we have this one. So that's it. 1, 2. These are the primary bull market uptrend lines, and 3. And so far, all we've done here is we've corrected back to it. So I'll give the bulls this. This is, again, if you want to use a bullish case, well, we just came and we checked and successfully tested the bull market uptrend line. And so maybe this one will continue. Maybe it'll go on to continue to exceed the record for the longest and strongest bull market in history. We'll see. A lot of indicators tell me otherwise. And again, I've said this quite a bit lately. How we close this month, that's why I need to see. I have the majority of my indexes need to close back on or in very close proximity to these the 20-month exponential and simple moving averages. I have the yellow up top. It's a simple. Does a great job of defining bull and bear markets. And from where we're at today, we only have a week to do it. We need to drop about 7% in the Nasdaq, right? And that would put us right back on that line. Or even if we drop 6, we're in close enough proximity to say, you know what, that's not a clear breakout. So that's where we're at, and that's my now. So that'll also flip that PPO, which is currently crossing bullish. But again, everything on this horizontal or vertical line, which is this month in June, finalizes on the last trading day of the month, which I believe is next Friday, if I'm not mistaken. Okay. All right. What else did I want to show you? Okay. This was what I mentioned before. For those that struggle with kind of get their hands around or their head wrapped around the magnitude of this rally. Again, this is the Nasdaq Composite, a much more accurate measure than using the Nasdaq 100, which is not a balance. It's the least balanced index that I know of by far. There's not even a close second. You know, the top 6 stocks making up over half the returns of a 100 stock index. So I've talked on that many, many times. This one's, you're not going to have that's as significant impact with those. They're in here, but they're just not weighted as high. So the bear market rally back then, turn off all the lines. This was here. I'll zoom in for you real quick. Go nice and tight. This was 2000 top right there. We had a drop down there. The first leg down was about 40. Well, there you can see my pop-up box to the left. Look down to the bottom in red. Tells you that was a 41.71% drop. If I grab the highs, I think I missed the highs there. I snapped to it there. Yeah, 41.71, same. 41, call that 42%. Then the ensuing rally from there up to the highs right there was 41%. So that's the numbers I did for you here. I measured that bear market rally. So number one, how does that compare to now? Well, so far from the lows right here, we've rallied 37.4%. Okay, so call that close enough. And again, I've said it many times, I believe that this bear market, based on what I showed you about interest rates and the impact they have, and talked about the parallels to Japan, their lost decade, I think this is where a lot of analysts and I just differ completely. I think it's going to be a lot longer and a much slower roll in a much larger bear market than the previous ones. So even the one back in 2000. Now, maybe not in percentage to the Nasdaq. We had the dot-com effect. The S&P didn't fall at 70-something% it did there. But with that being said, so ultimately we go on to break this trend line and that longer term secular bull market trend line I talked about. That's going to give us a potential for a lot more downside. But right now, the point I wanted to make is by many metrics, including the fact we're back testing the key 20-month moving averages that do a great job of defining bull markets when you're above it and then bear markets when you're below it, right? There's that. And then, you know me, I love my fibs. Let's have fun with fibs now. Let's go to this board here. And let's start where we're at today. Covered this many times. Here's the highs. 2000, it was actually November, for the Nasdaq. The S&P peaked right here. You had a slightly lower high in the Nasdaq right in the beginning of 2022, right there. So, but that is the official high. So that's where you start a Fibonacci retracement. You take that line from there down to the bottom, which I did here. It's this white line. And that tells that we hit to the button. See this dashed line, the 61.8 fib. So as of this point in time, I know I sound like a broken record, by this metric, which isn't everything, but it's one and it's a big one, this is just a typical counter trend rally. So now let's compare it to previous bear markets. Let's go back And let's look. I want to compare it. Let's start here with the 2000, the first bear market, the first significant bear market rally back in 2000. I'm going to zoom in real close again. I'm going to take it a little tighter. Let me just compress this a little bit more. Here we go. And there's a lot of lines here, but this one's yellow. You can see it. Let me just zoom in a little bit more. Grab this, zoom in, there you go. Okay, so there's the high in March of 2000. Here's your fib line right there, that dashed line, going down to the bottom. The line I drew, this is the bottom right here. That's where I put it. It's this, you would look at the horizontal line, not the slope of this doesn't matter. You're just measuring from the high to low. And you can see, so we rallied 1, 2, 3 months. On the third month, at some point during that monthly candle, we rallied exactly to the 61.8, and it was a run-of-the-mill counter trend rally. Now, run-of-the-mill, what is that? In percentage, it was 41%. It's almost exactly, even a little higher than we're at right now. What happened after that? Well, from there, if you got all bullish and started, going long, because the masses certainly were, sentiment was spiking after a 41% rally. How could it not? Then the market turned around and dropped from there 62%. And although at that time you put in pretty much you hit that high, you never went above it. You were about almost there. 2 months later, the market stalled out. Then the big drop came, and there was that implosion. So again, you have that. It was almost like that pressure. You had that. That's a big drop. You don't see bull markets go up in 7 months 62%. This is the thing about, you just have to be careful. Maybe we're in a new bull market that's going to new highs. If this is a bear market, you just want to make sure, first of all, you can profit tremendously. That's why I get excited about bear markets. Again, stocks fall much faster than they rise. That's one thing about it. It's like trading a bull market with the fast forward button on. Only because the fast forward button is on 3 times play or whatever it is, you have to be a lot faster. You can't be the last one to exit your shorts or too late to the party, because when it turns pretty quick. All right, so I think I did a good job there of just showing you in perspective, really, that it's run of the mill. And then the last, let me show you the last bear market that we had, true bear market again, in my opinion, the October of 2007 to March of 2009. I'm going to zoom in for you there and just show you what we did also on that one. So percentage-wise, the rally was 18.37%, so not as big. Measure from there to there, 18.37. And then Fibonacci-wise, retracement, levels, that is, you can see right here, I have these green fibs. There's the high right there. There's the low. And we split the crosshairs between the 50 and 61.8. I've always said this is your typical retracement zone. There are other key Fibonacci levels, but I like to keep the 38.2 up to the 61.8 because it shows me where a typical counter trend rally goes. And again, that from there, that was it. The following month saw a 10% drop off those highs. That trapped a lot of bulls that were buying, and we even cleared briefly, like you see intra-month, slightly cleared the 20-month moving averages. But from that point there was a 50% more downside, and that came in just 6 months. So again, just trying to put things in perspective. I'll be right or wrong on this call and every other call, but the point being that it can and will happen fast. You go from, and it takes that kind of bullish sentiment. It takes that in a bear market rally, the big ones. This is, again, what I'm viewing as the first big one, has to end in that point where most people are convinced that the bear market is over, and it ended there, and we're in a new bull market. You have to do that. Why do you have to do that? It takes that excessive bullish sentiment to clear out that sentiment, number one. Also short interest. I know people are I see the articles, the pump in the media that short interest is at super high levels. First of all, that data tends to be dated. And I also read that it was the highest level since, I think it was 2022 in, what was it, April. I think that's what I read recently, and I've seen the articles right here. Well, there's April. And so we had excessive high short interest somewhere in there, and you can see what happened to the market from there. So, in a bear market, you're going to have higher short interest. That's just part of a bear market there. Okay, just moving on real quick to the things that I'm watching. One of those being the banking sector. I've told you before my opinion, and that is just opinion, that three of the largest, or was it two or three? We had four total, two, or I think three of them were the largest in history, or the second, third, and I believe fourth largest bank failure in U.S. history, and all right on a flurry of them. And then all of a sudden the market just acted as if it didn't happen, there weren't going to be any more. And those are just usually the pre-shocks, if you will. And, I don't believe that everything's hunky-dory for the banking sector after that happens. I don't think you put a Band-Aid on it and it's okay. But either way, we'll watch it. I told you I don't have a horse in this race right now, but I may soon in the bigger banks. Maybe even the regionals. Pointed out yesterday, we broke down below that 41.39 support and the uptrend line right there, and the regionals continue to sell off. I mean, they're still below their lows, and this just could prove to be a corrective wave. And if you are, very bullish on the market or the banking sector, you want to buy dips. Where does it start to, kind of chip away at the bull case? Well, there's a reaction low, there's one, and there's one. So if and as each are taken out, then that increases the odds we may go on to take out the previous lows and have another big leg down or another problem. So just again, monitor the sector. I like to look at the individual components. If you see one, so far what I'm noticing, and I'm not going to go through them all here, when I click on KRE, it populates a watch list, all the holdings, and I'm looking for any chinks in the armor, any one or any individual banks or other financial institutions that seem to be falling a lot more than the others. That's what you want to watch out for. That'll tell you most likely. Sometimes you get a random surprise, it just happens, but usually the little birdies out there, those in the know, will start to sell anticipation. So I'm watching that, and again, just something to monitor. Today had a comment from Trade 39, who mentioned JP Morgan, shared some charts, asked my opinion. I agree. It's the same exact charts. The only thing, I had a divergent high on JP Morgan. JP Morgan, as we all know, is the king of banks. They are the 800-pound gorilla in the sector, considered the best run bank in the world, largest and all that. And what you have here is a nice, clean uptrend line right there. Same one that Trade 0039 had. And I have this divergence here, just like you had divergence right here. You had divergent high and a similar trend line. It's really been a series. When that one broke, one big red candle right there, and then boom, the drop from there was in very short order. It fell and on the breakdown, not from the highs, from the breakdown point, 13%. This is even larger trend line with even larger divergence. This divergent high is just a continuation of that previous divergence. That's what I'm doing right now, showing you those lines. That's a higher high all along. It's been making lower lows. So by that, typically, again, there's no ratio or formula on divergence and how far something drops. But generally, the bigger the divergence, the bigger the ensuing drop, which could mean, and again, it's something to watch for. I'm sharing it both as a trade idea. You need to take out today's lows. We're really flirting with the trend line and that 138-ish support right here. But if it breaks, first target 134.20. You can see all these marked levels. These are older. These are the near-term targets right there. So I have to update, and I'll give you, and I'll do it right now for just in case this happens. I'll be leaving town towards the end of next week for another short mini vacation, but I'll be working on that one, going to North Carolina for just about a week. And I'll bring a laptop with me and get some things done and get posts out to you. Anyway, those are the near-term levels. But again, based on the magnitude of that wedge, and if you want to take the measured target, you just take the widest part of the wedge, which I'm going to do right here. That would be right about to this point here, roughly. And then add that to where the wedge breaks down. That's going to bring you down here quite a bit. If that happens, that's going to have most likely have bigger implications on the stock market. Because if JP Morgan were to fall any part or a good part of that 16% and start to get near those previous lows, that's going to be a rut row moment for the stock market and the economy. It's going to tell you something's still rotten in the banking world there. So again, something to watch. Also a trade idea if you're inclined. Looks good to me. No sell signal yet. You need the breakdown. So it's a trade setup. Okay, and a quick update on the euro. If you've seen any of the recent videos, been watching the euro, we've got a pretty decent resistance level there to 109,375-ish. Tried to pop, but couldn't hold it. Failed the next day. Breakdown, as well as this little minor trend line here taken out. And I've shared the positive correlation with the stock market and the euro, meaning when the euro goes down, the stock market goes down. And on numerous occasions, the turn has first come in the euro, then the stock market follows. So that was what was it, yesterday? I gave you this 60-minute bearish rising wedge with negative divergence to watch and told you a sell signal will come on the break of that. I think that's safe to say that's a sell signal. I think that's safe to say that's an impulsive breakdown. If you look up impulsive breakdown in the dictionary, if there was such a term, which there's not, that's what it's going to, you'll have a picture of this. That's what you want to see. And this level here created that back on March 31st, and I have not, let's see, it's not been modified. We hit that to the button. So that was a support level. We bounced. As you're going to go down that much, you're going to get a reflexive bounce. But that's a sell signal. And so it takes us back below the daily support level. And, where we go from here, it happened quick. It could have been a short trade if you're a currency trader. You could have shorted the euro, gone long the dollar. I'll show you those charts here in a second. I believe these were just shared with you yesterday. This is the dollar index, DX, dollar futures. Beautiful little bullish falling wedge. And we were right here. I said, break of that, it's going to pop the dollar, and it did. And so that's by mere coincidence. The stock market's down today with the dollar up and euro down. No, that's what. And then earlier, the reversed, pulled back, and that's where so far the stock market's off its lows. Here, I'll show you that in one sec. Okay, I also showed you the euro yesterday with the negative divergence that it had, and this uptrend line and horizontal price support, and boom, you got that sell signal today. And this coincided this breakdown here, trying to circle it, there it is, with the drop in the stock market, and then the stock and euro bottom there today and bounce. So did the stock market. Here, we'll look at it this way. Euro overlay, edit chart properties. We'll do the Qs, QQQ, or you can do SPY. They're going to look the same. And let me do this. Let's change it to FXE. Let's go down to a 1-minute chart, and or we could do a 5-minute chart, because the problem is the stock market's going to show you trading in regular session hours. The currencies trade around the clock. So we go here, edit chart properties, and put on the Qs. There it is. There's your correlation right there, guys. So if you could have anticipated, like we looked at yesterday, that bearish rising wedge in the euro and the bullish falling wedge in the dollar appeared ripe to break out. It's one thing to point them out. They were at that point. Wedges usually break about, give or take, 70-80% to the apex of the wedge, and that's right where we were. So those wedges were ripe for breaking down, and then you can see that here it is. The big drop in that's that gap. The comparison's not on candlesticks, so there's a gap down today in the Nasdaq and S&P, and that's it. That was coincided with the gap down in FXE, and so there's your correlation. And they both bottom. We got a little bounce so far in the markets, and near term, very near term, I don't know. We broke down, like I said, 60-minute chart, EUR, USD. We're certainly near-term oversold, so I don't have very near-term micro analysis. I don't know, but I'm going to tell you right now, this probably will cap that bounce right there. About we almost hit it today, and that's support right there. And support once broken becomes resistance, and it's looking a little flaggish here. So ideally for for those of you that are short the equity markets right now and the semis and all that, you want to see this today, or if it happens over the weekend, this forex will be trading on Sunday and all that, whenever You want to see another leg down there in the euro, and that'll coincide with another leg down, most likely in the stock market. Okay, let's cap this video here. Let's just end it on the semis, because it's all stock market related, and then everything else, commodities. I already told you, wheat, natural gas, they hit their, they're all at price targets in the last couple of days, consolidating there. The very near term are, I'll put it this way, near term, neutral to bearish, maybe a little pullback, offset the work off the overbought conditions, but I remain intermediate to longer term bullish on those two of my favorites, wheat and natural gas. So that's that update for you there. Let's just today, who knows, next week, next month, most likely higher next month especially. All right, so semis, here's what we want to watch. Start to maybe get a little downtrend line forming there. But what happened today, we gapped down just like the markets, and that was due to that overnight move in the euro, the drop in the euro, the spike in the dollar, took the equity markets, including the Nasdaq 100, which then took and the semis continued to outperform on the downside. So this is, my favorite sector right now on the short side, and it's playing out pretty well. We're still not to my first target. You may have wanted to take profits, or already did that there on that 5% drop. But I just wanted to give you the update and tell you that I like it. Where markets, the Nasdaq and the S&P are bouncing now. So far, very muted, if any. The semis just they're underperforming by quite a bit, and I like that. That's showing relative weakness. That when you have relative weakness, that's one sector, one index against another, and it's acting weaker, and that's what you want to see, especially if you're short. So we took out that support zone there, 407 to 489 and a quarter, and we're below it. There's the gap right there. Ideally, again, you don't always get what you want, but ideally I'd like to see any bounce in the semis should we get one. Maybe they want to backfill that gap before going on. And then there's T1. And T1, like I told you before, is a rough target. Still the first target, but I still maintain this is my preferred swing target, whether we bounce on T1 or not. I still think there's a good shot to head on down to T2, which is the uptrend line, and or that 44.70-ish level. They come in together, and that's going to be a, again, whatever I told you before. I think 12% drop if hit from, 13, almost 13% from where we shorted. So still like it, and so far so good. What's not to like about that? All right, guys, I'm going to wrap it up here, and if anything stands out that I missed, I'll get it out to you later in another post. Otherwise, it's Friday. If nothing big happens by the end of the day, this might be my last video. So if I don't do another one, have a great weekend, and we'll pick it up Monday.